February 2026, silver didn't just fall, it exposed something. When metal moves from $100 to 73 in days, that's not sentiment, that's not panic, that's forced behavior. The kind that only shows up when the plumbing breaks. And while everyone was watching the price, they missed what the price was pointing to. A credit structure measured in trillions, a policy response already being drafted, and a timeline shorter than most people think. The crash cleared leverage, but it didn't clear the problem. And what comes next isn't about silver anymore. Welcome to John Analyst. If you've made it this far in life without subscribing to channels that waste your time, I respect that. But if what you just heard sounds like information that deserves more than 30 seconds of your attention, then consider this an invitation, not a sales pitch. An invitation to stay informed while others stay distracted. The subscribe button is below. It's there for people who understand that real analysis doesn't come with confetti and hype. It comes with structure, evidence, and the kind of clarity that helps you make decisions before the crowd does. And one more thing, drop a comment right now. Tell me where you're watching from. Not because I'm collecting data, but because I want to know who's paying attention while the rest of the world is looking the other way. Now, let's begin. February 10th, 2026. The day silver stopped behaving like a market and started behaving like a trapdoor. The price didn't ease lower with a kind of orderly decline that gives traders time to reconsider positions or adjust risk. It collapsed. $100 per ounce to 73 in sessions that felt more like minutes than days. And the speed alone told anyone paying attention that this wasn't about investors changing their minds. This was forced behavior, the kind that only emerges when the system's plumbing reaches maximum stress and something has to give. Financial media scrambled to explain the move with the usual narratives. Sentiment shifts, profit-taking overbought conditions. But they missed the structural reality entirely. Because when precious metals move with that kind of violence, it's never grandmother liquidating her coin collection. It's never retail speculators getting cold feet. It's leverage being unwound at gunpoint. It's margin calls being answered with whatever liquidity can be found. It's the invisible architecture of modern markets revealing cracks that don't show up on price charts during calm conditions. The distinction between voluntary selling and mechanical liquidation matters more than most investors realize. One tells you about psychology. The other tells you about structure. Psychology reverses when fear subsides. Structure doesn't repair itself just because prices stabilize. And what happened in February was structural. The trigger wasn't hidden in some conspiracy or manipulation scheme. It was documented in official exchange notices that barely registered as news. COMEX, the clearinghouse that processes the majority of North American precious metals futures contracts, had been systematically raising margin requirements throughout January and into early February. Margin functions as the gatekeeper in futures markets. The collateral required to maintain open positions. When that requirement increases, every participant holding leveraged positions faces the same binary choice. Deposit additional cash to meet the new standard, or close the position. There's no negotiation. No grace period, no third option. And here's where the mathematics become brutal for anyone operating with significant leverage. A trader running 10-to-1 leverage doesn't experience a 2% margin increase as a minor inconvenience. They experience it as a 20% demand on their deployed capital. What looks like a small adjustment in percentage terms becomes a major liquidity event in dollar terms. And when you're already fully committed to a position based on previous margin levels, finding that additional capital means liquidating something else or exiting entirely. Multiply that dynamic across thousands of participants holding similar positions in a crowded trade. The result isn't orderly price discovery where buyers and sellers meet at equilibrium. It's a cascade. Liquidity evaporates exactly when it's needed most. Bid offers widen from pennies to dollars. Orders hit market with no regard for execution price because the imperative isn't maximizing returns anymore. It's meeting collateral demands before the exchange forces liquidation at even worse levels. This is mechanical selling in its purest form. Participants aren't bearish on silver's fundamental supply-demand outlook. They're not responding to changed economic data or shifts in monetary policy. They're responding to system-imposed requirements that leave zero discretion. The irony that makes this collapse more significant than typical volatility, the margin increases. Triggering the forced selling weren't arbitrary. Exchanges don't raise collateral requirements because they enjoy disrupting markets. They raise them when their internal risk models indicate elevated exposure that needs containment. The volatility metrics, the position concentrations, the clearinghouse's assessment of potential default scenarios, something in those calculations triggered defensive action, which means the forced selling that created the crash was itself a response to risks the exchange was already seeing. The feedback loop becomes almost circular. Elevated risk prompts higher margins. Higher margins trigger forced liquidation. Forced liquidation creates the volatility that justified the margin increase in the first place. And this is where the narrative shifts from simple price correction to potential warning signal about structural issues that extend beyond silver. Because institutions responsible for clearing these contracts don't act defensively unless they perceive threats to system stability. If COMEX felt comfortable with existing risk levels, margin requirements would have remained unchanged. The fact that they didn't, the fact that collateral standards kept rising even as prices were already falling, that suggests the risk assessment driving those decisions wasn't about silver's price level, it was about something underneath the price, something in the leverage architecture, something in the credit relationships connecting participants, something in the clearing mechanics that made the exchange uncomfortable enough to keep tightening standards despite knowing it would accelerate selling pressure. The February collapse cleared the weak hands, flushed the excess leverage, reset positioning to levels where the remaining participants could actually meet collateral requirements. But it didn't address whatever prompted the defensive measures in the first place. That underlying risk, whatever its source, remains embedded in the system. And the fact that it's showing up in a market as established and liquid as precious metals futures suggests the stress isn't isolated to one commodity. It's connected to something broader, something in the credit architecture that underpins how modern financial markets actually function. When you look beneath the surface level price action, everyone's watching. What happens next isn't about whether silver recovers to $100. It's about whether the system that just forced this liquidation can handle what's coming in the credit markets it's actually connected to. The silver crash didn't happen in isolation. And understanding why requires looking at something most market participants prefer to ignore: the shadow banking system that's been growing behind the scenes while everyone was focused on stock indices and cryptocurrency narratives. Private credit, direct lending, non-bank financing, call it whatever label makes it sound less threatening. But the reality is simple. There's now a multi-trillion-dollar lending infrastructure operating outside traditional bank balance sheets, outside conventional regulatory oversight, outside the transparency requirements that apply to public markets. This isn't conspiracy theory material. This is documented in central bank reports, systemic risk assessments, and the financial disclosures of the largest institutions in the world. The scale alone should command attention. Conservative estimates place global private credit markets somewhere north of $2 trillion. Some analyses suggest the real number, when you include all the interconnected structures, could be significantly higher. But scale isn't the primary concern. Structure is, because the way this market works creates specific vulnerabilities that don't exist in traditional banking. Money flows from investors seeking yield in a world where safe returns have been suppressed for over a decade. That money gets pooled by asset managers and specialized funds, and then it gets deployed to borrowers who either can't access traditional bank financing or choose not to because private credit offers different terms, fewer covenants, less scrutiny. The borrowers range from middle market companies to real estate projects to leveraged buyouts that banks won't touch at those risk levels. And here's where it gets interesting from a systemic perspective. The lenders in this market promise their investors something that's increasingly difficult to deliver: liquidity. They structure these products to look and feel like they can be redeemed or sold on relatively short notice. But the underlying loans are often anything but liquid. Commercial loans don't trade like stocks. They require negotiations, approvals, legal documentation, and most importantly, a willing buyer. So you have a fundamental mismatch. Assets that are locked up for years being funded by capital that expects to be available in months. The mismatch stays hidden during call markets when redemptions are manageable and everyone's performing. But when stress hits, when investors want their money back simultaneously, the illusion breaks. And this is where the connection to commodity markets like silver becomes clear. Because the institutions providing this private credit, the funds managing these strategies, they don't operate in a vacuum. They have their own financing arrangements with major banks, credit lines, prime brokerage services, derivative hedges, collateral agreements. The banks, in turn, have exposure to these non-bank lenders through multiple channels: direct lending commitments, warehousing facilities for loans that haven't been syndicated yet, credit default swaps that transfer risk without transferring the actual loans, total return swaps that provide synthetic exposure. The web of connections runs deep, and the publicly disclosed numbers, when regulators bother to aggregate them, run into the trillions, not billions, trillions. And the critical detail that gets overlooked in polite financial discourse is this: nobody actually knows the full extent of these interconnections because there's no comprehensive reporting requirement. Banks know their exposure. Funds know their exposure. But there's no central ledger showing how a default in one corner of this market cascades through derivative contracts into balance sheets 3 or 4 steps removed from the original loan. Recent evidence suggests this opacity creates real problems when marks have to adjust to reality rather than optimistic projections. In late 2025, a widely held middle market lending fund publicly acknowledged a markdown approaching 20% in a single quarter. The market reacted with shock, not because sophisticated investors didn't understand credit risk exists, but because the markdown revealed that previous valuations had been, to put it diplomatically, optimistic. Loans that were being carried at par or near par suddenly repriced to reflect actual market conditions, and the gap between what investors thought they owned and what they actually owned became painfully visible. Now, one fund marking down doesn't prove systemic collapse is imminent, but it does prove that marks in this market can move. And when they move, leverage becomes uncomfortable very quickly. Because here's the mechanism that connects private credit stress to silver's volatility. When credit marks deteriorate, funds face margin calls on their own financing arrangements. Those margin calls require liquid collateral. And liquid collateral in a stress environment means selling whatever has a bid. They don't sell their liquid loans. They can't. They sell their liquid positions. Stocks, bonds, commodities, anything that can be converted to cash within settlement cycles. Silver, with its volatility and deep futures markets, becomes exactly the kind of asset that gets liquidated to meet credit obligations that have nothing to do with silver fundamentals. The forced selling we saw in February wasn't about silver supply and demand. It was about collateral management in a system where private credit stress is forcing portfolio liquidations across multiple asset classes simultaneously. And here's the part that should keep anyone holding leveraged positions awake at night. This markdown event in late 2025 wasn't an isolated incident. It was a preview. A single fund in a single quarter, repricing a portion of its book to reality. Now imagine that process spreading. Imagine multiple funds facing similar reassessments as economic conditions deteriorate, or as borrowers that looked solid 12 months ago start showing strain. Imagine the redemption requests that follow when investors see those markdowns hit their statements. Imagine the liquidity crunch when funds that promised near-instant redemptions discover they can't sell the underlying loans fast enough to meet withdrawal demands. That's when the fire sale begins, not in private credit itself, because those loans don't have liquid markets, but in everything else those funds and their financing counterparties hold. Treasury positions, equity holdings, commodity futures. Anything with a functioning market becomes a funding source for obligations that can't be met any other way. And the institutions financing these private credit operations, the major banks providing warehouse lines and derivative hedges, they're not insulated either. Their exposure runs through credit agreements that looked conservative when private credit was performing. But when performance deteriorates and covenant breaches start accumulating, those credit lines get pulled or repriced, which forces another round of liquidation, which hits commodity markets again, which is why silver's February collapse might not have been the main event. It might have been the warning tremor before the structural shift that hasn't fully begun yet. The conversation around confiscation risk in precious metals has been dominated by historical analogies that no longer apply. And this misunderstanding leaves investors focused on the wrong threats, while the actual policy tools being developed operate in plain sight. When most people hear gold confiscation or silver confiscation, their minds immediately jump to 1933. Executive orders, mandatory turn-ins, criminal penalties for noncompliance, the entire dramatic apparatus of government seizure. And yes, that happened. But the conditions that made it possible, the monetary architecture that made it necessary, and the enforcement mechanisms that made it practical no longer exist in the same form. The 1930s operated under a gold standard where currency was directly convertible to metal at fixed rates, which meant government control of gold stocks was essential to monetary policy execution. Today's fiat currency system has no such constraint. Central banks can print without metal backing, which eliminates the primary justification for physical confiscation. More importantly, gold and silver ownership in the modern era is distributed across millions of private holders, stored in thousands of private facilities, held in forms ranging from coins to bars to allocated accounts to ETF structures. The logistics of door-to-door enforcement would be politically toxic, operationally complex, and strategically unnecessary when simpler tools achieve the same objective with less resistance. So the 1933 scenario, the one that dominates internet forums and generates the most anxiety, sits at the bottom of the probability scale. Not because governments have become more respectful of property rights, but because they've developed more efficient methods. The modern confiscation spectrum operates on 3 tiers, each progressively more likely, each progressively harder to recognize as confiscation when it's actually happening. Tier 1 is direct seizure, the historical model, the dramatic version, the scenario that gets all the attention despite being the least probable outcome. Tier 2 is where the real action lives, taxation and regulatory capture. This doesn't require any announcements about taking your metal. It just requires changing the rules around what happens when you try to convert metal into spending power. Current tax treatment already demonstrates the principle. In the United States, certain forms of precious metals exposure face collectibles tax rates that can reach the high 20s on long-term gains before state taxes or additional levies get added. That's already a heavier burden than equities face, and it exists without any controversy because most voters don't own precious metals and therefore don't care about the tax treatment. Now extend that logic into a scenario where gold hits $5,000 per ounce and silver breaks through previous all-time highs by significant margins. Suddenly, precious metals become visible. They become dinner table conversation. They become symbols of wealth that politicians can target without political cost. The playbook writes itself. Establish a reference price. Label anything above that reference price as windfall gains, and implement a special tax rate for those excess profits. It gets packaged as fairness, as making sure those who benefited from crisis or inflation or whatever narrative fits the moment contribute their share. The public applauds because they're not in the trade. The revenue flows to the treasury. And metal holders discover that their gains get taxed at rates that weren't disclosed when they made the initial investment. This isn't theoretical. State-level proposals for wealth taxes targeting ultra-high net worth individuals have already introduced the concept of taxing balance sheets rather than income. And some of those proposals include exit tax provisions designed to capture value when wealthy residents attempt to relocate. The fact that these haven't passed yet misses the point. The point is that the legislative frameworks are being drafted, tested, refined. When the fiscal pressure becomes severe enough, when deficits demand new revenue sources, these tools will be available. And governments don't need perfect enforcement. They only need enough compliance to generate revenue for the next budget cycle. Policy doesn't always optimize for 10-year outcomes. It often optimizes for immediate fiscal needs. So don't assume bad policy won't happen, because it's economically destructive in the long run. Bad policy happens all the time. That's why it's called policy. Now, Tier 3 represents the endgame scenario that doesn't require taking metal at all. It just requires controlling the payment rails that convert metal into usable currency. Central bank digital currencies may or may not get implemented on the timeline advocates suggest, and political resistance in certain jurisdictions may delay or block full deployment. But the direction of monetary infrastructure is clear: more digital, more traceable, more controllable. The mechanism doesn't require anything as crude as shutting off someone's wallet. It can be far more subtle. Transaction delays for verification, automatic withholding for tax compliance, documentation requirements that create friction, limits on transaction sizes or frequencies for assets deemed sensitive or speculative. The effect is the same as confiscation without the optics. Metal holders discover that converting their physical assets into spendable currency involves hurdles that didn't exist before, hurdles that reduce the practical value of the metal, even if ownership technically remains private. None of this requires conspiracy. It just requires governments doing what governments always do when fiscal stress meets political opportunity, finding the path of least resistance to capture resources. And that path runs through taxation and payment system control, not through the dramatic seizures that dominate the confiscation conversation, but represent the least likely implementation method. Imagine this scenario playing out in real time. You own physical silver purchased at $30 per ounce. The price reaches $150 during a monetary crisis. You decide to sell and convert to currency, but instead of receiving cash or a simple bank transfer, you receive central bank digital currency with embedded rules. Maybe it's reportable above certain thresholds with automatic tax withholding at the new windfall rate. Maybe transactions over $10,000 trigger enhanced due diligence reviews that take weeks. Maybe precious metals, when transactions specifically get flagged for additional scrutiny because of policy concerns about capital flight or speculation. The metal is still yours. Nobody knocked on your door. But your ability to move from metal to spending power just became conditional, delayed, expensive, controlled. That's modern confiscation, not the taking, the narrowing. And if that sounds paranoid, ask yourself a simple question. Do you think future governments will want less visibility into money flows or more? Do you think the trend is toward fewer controls or more controls? Because the answer to that question determines whether Tier 3 is a distant possibility or an approaching reality that just hasn't been formally announced yet. The policy infrastructure is already being built. The legislative language is already being drafted. The technological capability already exists. All that remains is the political justification. And fiscal crises provide excellent justification for measures that would be unthinkable during prosperity. The practical question that emerges from understanding mechanical liquidation risk, private credit fragility, and policy tool development isn't whether to hold precious metals exposure. It's how to structure that exposure in ways that survive the volatility ahead while maintaining optionality for the repricing that system stress will eventually force. And this requires distinguishing between paper claims that exist inside the leverage system and physical positions that exist outside it. Because the difference determines whether you're holding an asset or holding a derivative of someone else's promise about an asset. Exchange-traded exposure, futures contracts, even certain ETF structures operate within a framework where rules can change overnight. Margin requirements get adjusted. Settlement terms get modified. Cash settlement gets substituted for physical delivery when pressure builds. None of this makes these instruments useless, but it does make them vulnerable to the exact kind of forced liquidation mechanics that drove silver's February collapse. If your entire position sits inside a structure where the exchange or the clearinghouse or the prime broker can demand additional collateral or force liquidation based on their risk assessment rather than yours, you're not actually controlling your position. You're renting space in someone else's risk management system. Physical metal held outside the banking system, stored in allocated form where specific bars or coins are identified as yours rather than pooled, removes that overnight rule change vulnerability. But it introduces different complications: storage costs, insurance, liquidity when you actually need to sell, and the Tier 2 confiscation risks discussed earlier around taxation and payment controls. There's no perfect structure, only trade-offs that align with different risk tolerances and different views on how system stress will manifest. Mining equities represent a third option that combines aspects of both approaches. They're paper securities that trade with all the volatility and liquidity of public markets, but their value derives from physical metal in the ground rather than financial contracts. And this creates a leverage dynamic that works in both directions with equal force. When metal prices rise and mining costs remain relatively stable, profit margins expand exponentially, because the revenue per ounce increases while the cost per ounce doesn't move proportionally. A miner producing at $60 all-in sustaining cost sees their margin double when silver moves from 80 to 100, and that margin expansion typically drives equity values higher faster than the underlying metal moves. But the reverse is equally true and equally violent. When metal prices fall, those same margins compress toward zero or beyond, and equity values collapse as the market prices in operational stress or potential insolvency. This is why miner selection can't be casual. It requires evaluating whether a specific company can survive the bad weeks without forcing shareholders into positions where they're selling at the bottom just as the liquidation cycle completes. The framework for evaluation starts with cost discipline. And this means looking beyond headline cash costs to all-in sustaining costs that include sustaining capital expenditures, corporate overhead, and the real expense of maintaining production. Mines that operate with thin margins, where the gap between cost and metal price is narrow, become binary bets rather than investments. If metal prices stay elevated, they perform. If prices pull back even modestly, they face existential questions. Production trajectory matters because shrinking output, even from mines with good grades, signals geological challenges or operational inefficiencies that will eventually hit financial performance. Jurisdiction determines everything from permitting timelines to royalty structures to the risk that political changes invalidate the entire investment thesis. This isn't abstract. This is the difference between projects that move forward and projects that get nationalized or indefinitely delayed. Balance sheet analysis separates companies that can fund their operations and growth through cycles from companies that will dilute shareholders repeatedly or face refinancing risk at the worst possible moments. Development stage defines the risk profile entirely. Producers generate cash flow today. Developers promise cash flow years from now if everything goes according to plan. And explorers offer exposure to potential discoveries that may or may not ever become mines. Each category belongs in different portfolio allocations with different position sizes, and the element most investors ignore until it's too late: share structure and dilution patterns. Because management teams that consistently issue new equity to fund operations or acquisitions destroy shareholder value even when the underlying assets perform. A company can discover the richest deposit in its district and still leave shareholders with losses if the equity base doubles every 18 months through financing rounds. The physical inventory situation at COMEX adds another layer to the positioning decision. Because it reveals how tight the relationship between paper claims and deliverable metal has become, registered inventory, the portion actually tagged as available for delivery, has been sitting around 100 million ounces, while open interest represents multiples of that in notional claims. This doesn't automatically guarantee default or force majeure. Exchanges have cash settlement provisions and economic incentives that usually prevent outright failure to deliver. But it does create fragility. When deliverable inventory shrinks relative to outstanding claims, the system becomes more vulnerable to squeezes. And squeezes produce exactly the kind of violent price action that shakes out weak hands before the fundamental repricing occurs. The February collapse may have been that shakeout, clearing leverage before the next delivery pressure builds. Or it may have been the first visible crack in a structure that will eventually force a much larger adjustment between paper pricing and physical reality. The answer determines whether the next major move in silver comes from industrial demand recovery or from a forced reconciliation between the promises outstanding and the metal available to satisfy them. And positioning for both scenarios simultaneously requires holding physical outside the system while maintaining trading exposure inside it through carefully selected miners that can survive volatility without forcing exits at inopportune moments. Because here's what the February crash actually taught anyone paying attention. Volatility in precious metals isn't a bug. It's the feature that throws people off right before the next leg. The investors who panic during mechanical liquidations are the same ones who miss the repricing when the underlying structural problems they were warned about finally surface in ways the market can no longer ignore. The crash cleared the weak hands, but it didn't clear the conditions that made the crash necessary. Those conditions, the private credit vulnerabilities, the clearinghouse concerns, the policy tools being refined for implementation, those remain embedded in the financial architecture. And when they manifest in the next phase, the move won't be about whether silver recovers to previous highs. It will be about whether the paper markets can maintain the fiction that promises and metal are the same thing when the gap between registered inventory and outstanding claims forces a reckoning that exchanges can no longer smooth over with margin adjustments and cash settlements. What happens next is bigger than silver, but silver will be where you see it first.